Hi, and welcome back to the Business Career College video series. Again, this is Jason Watt, and what we're going to talk about today is annuity taxation. Now, it's nothing complicated with annuity taxation. We do learn a couple of useful concepts here. The very first thing that I will mention is that if you have a registered annuity, that is an annuity that was purchased with RRSP or LIRA, or RIF or LIF or pension money, that annuity is going to generate fully taxable income because everything that you put into that product went in on a tax advantaged basis. Now when we take it out, it's going to be fully taxable. Okay, that's easy. What we're going to have a look at for the rest of this video is the non-registered annuity. So this assumes that I have some non-registered or open money, and with this non-registered money, I'm going to use it to purchase this guaranteed income stream, this annuity. So let's assume that we have $200,000 of principal. That is, I have $200,000 available here. And I'm going to take that $200,000 and I'm going to get an annuity benefit of, let's say, just for the sake of argument, $14,000. Now, I know that the insurance company is going to guarantee me that $14,000 a year, and in this case, we'll deal with a life annuity. So we'll say they'll guarantee me that right until mortality. Of course, I could have guarantees or survivor's benefits, but we'll just deal with an ordinary, what's called life straight annuity or straight life annuity. And that $200,000, it is invested and it's earning interest income. So let's say we're getting a 3% return here. You won't normally see this. This is not a very transparent figure. Insurance companies will just tell you how much tax consequence you're going to have. But at 3%, my $200,000 will generate $6,000. So I've got $200,000 invested, $6,000 of interest income, and of course, as we've seen previously, if I have interest income, that is taxable. So I would have also $6,000 of taxable income in that year that would just get added to my income for the year. So where does the $14,000 come from? Well, the interest helps to form part of that, but that means we still have to take some of that out of principal. We're going to take $8,000 out of principal here. So really, this $14,000 represents $6,000 of interest income and $8,000 of what we call return of capital. This portion, the $8,000, is not taxable because I'm using my already after-tax dollars to buy this annuity. Now, if we've taken $8,000 out of principal, that means I'm really left with, if we can go to year 2, I'm really left here with $192,000. And that's the amount now that's going to generate this 3% return. $192,000 at 3% is not going to generate $6,000 for me. It's going to generate only $5,760. So that $5,760 goes to help purchase, again, this guaranteed $14,000 income stream. If we're going to get to $14,000, then we have to pull more than $8,000 out of the annuity. We have to pull $8,240 out. $8,240 here and $5,760 here gives me my required $14,000. Now, the insurance company manages that whole process. I have nothing to worry about here. They really take care of everything. So then, in year 3, we're now going to have even less than 192,000. We had 192, we took away 8,240, In year 3, I would have $183,760. That's the amount that's now invested, and it's earning, again, just as it was last year, 3%. So it's going to generate for me $5,513 of interest income. That's going to help to fund the $14,000 guarantee or promise that my insurance company made for me. That means out of that $183,760, I now have to take a little bit more money. I have to take $8,487. That $84.87 plus this $55.13 will give me the $14,000. Now you can see what's going to happen here. If I live long enough, that annuity income, or that annuity principal amount, sorry, is going to drop to zero. If that should happen, it doesn't affect me. That's the insurance company's responsibility. If that reduces to zero, that's their problem, not mine. They made me a promise. The promise was they would pay me $14,000 a year until mortality. So basically, they now have to come up with the money out of their reserves to continue paying me the promised benefit. Now, what's going to be taxed here? Well, in year 1, we saw $6,000 of taxable income. In year 2, we'll have $5,760 of taxable income. And in year 3, we'll have $5,513 of taxable income. Just like my annuity benefit's going to drop off to zero, eventually that will drop off to zero as well. Now, with a non-registered and immediate annuity, I do have one more option available. I can choose what's called prescribed taxation, or sometimes we call this proportional taxation. So this is a prescribed annuity contract or proportional taxation. And what I'm going to do here is I'm going to level out the tax bill. And this is permitted under the Income Tax Act. And what I'm allowed to do here is we say, okay, we know we're going to have $14,000 a year of income. Let's say that my mortality is expected to be 20 years from now. I'm going to end up generating a total of $280,000 in that annuity. I started with $200,000. It's not exactly the right term to use here, but we could roughly say we have $80,000 of profit. Okay, so roughly $80,000 of profit here, which means $80,000 over 20 years, I'm really profiting $4,000 a year on a proportional basis. So it's $4,000 a year. So instead of having this decreasing tax bill, what I can actually have here is I can have a tax bill that will be $4,000, $4,000, $4,000, and so on. It will always be $4,000. It'll stay level. So you can see here that it does represent a fair bit of tax savings. That knocked my income down by a fair bit in each of those years. Yes, if I live too long, eventually I'll start to end up paying more tax than I otherwise would have, but initially it does help me out a fair bit, and the savings here are fairly obvious. So you may want to choose the prescribed rate annuity. Keep in mind it has to be an immediate annuity, meaning that you start generating income from it right away. It's not an accumulation annuity or a deferred annuity. And this tax structure only works with a non-registered annuity. Okay, that's my annuity taxation. Fairly straightforward. I know the prescribed annuity is a little bit complicated, but you're not going to have to recreate this math at the life license qualification program level, you may have to recreate it at the certified financial planner level. I simply give you the math so that you understand how the concept works. I hope it does help. I hope that the taxation of annuities is clear for you. And please let me know if you do have any questions. Thank you very kindly. Enjoy your stay.